So there's a version of investing where every down year just feels like a loss. Red in your portfolio, it's bad vibes, nothing to show for it. None of us like it, right? And there is a way to pull off real money out of the tax code and compound it for decades. And what's the difference between these two versions, you may be asking? It's one strategy I'm going to talk about, and most young investors have never heard of it. And what's up, guys? Welcome back to the channel. It has been a while since I've posted, so today I want to talk about something called tax loss harvesting, and I don't mean like the service level stuff that you can just Google. I mean the actual mechanics, the correlated ETF swap that makes this work. And we're going to talk about the wash sale rule and how to stay clean with the IRS. And then we're going to run the math on what's compounds to if you were to start doing this early in your 20s, because that number is not small. So let's go ahead and get into it. So I kind of want to start simple. So what even is tax loss harvesting? It's when you sell an investment that has dropped in value, realize that loss on paper, and then use that loss to reduce your tax bill. That's the whole idea. Here's how the IRS lets you use it. You can use harvested losses to offset capital gains dollar for dollar. No capital gain that year, that's all right. You can still offset up to $3,000 of ordinary income annually, and any losses you don't use don't disappear. They carry forward to future tax years indefinitely. So you sell something down, capture the loss, buy back into essentially the same exposure, and you just turned a bad month in the market into a tax asset. The key word here is essentially the same exposure, right? Because that's kind of where things get complicated. But I just want to say, even if you have like an investment that you sell for a loss and you don't have any capital gains to offset it, you're still able to like write that off as ordinary income, as I previously just stated. And ordinary income is taxed at a higher rate than capital gains rate. So, and the fact too how you can carry it forward is just huge. So, but you do need to understand the wash sale rule. Essentially, the IRS is not going to let you sell VOO or VOO, like the S&P 500 ETF, and merely buy back into VOO and claim the loss. That would just be free money with no real economic change. So they created the wash sale rule. The rule says you cannot buy back the same or substantially identical security within 30 days before or after the sale. If you do, the loss is disallowed. It gets back into your cost basis and you don't get the deduction. So that 30-day window on both sides is important. A lot of people miss the before part. You can trigger a wash sale before you even sell. Now, things do get a little bit interesting here. The IRS has never precisely defined what substantially identical means for ETFs, and there definitely is a gray area when it comes to the strategy. So now I want to talk about the actual strategy. The goal is to swap into something that is highly correlated to what you sold, and it tracks different enough to avoid the wash sale risk and keeps your market exposure basically unchanged. So I'm going to share with you the pairs that I wrote down, and I'll share with you on the screen. And this is what a lot of people use. So the first one is VOO and VTI. VOO tracks the S&P 500. VTI tracks the total US stock market, and their correlation is around 0.99. So basically the same thing. Different index, different fund, but it's a clean swap. So again, if one of them has like a down year or down month, you can just sell it and then buy into the other one, and they're highly correlated. Another one I want to talk about is QQQ and QQM, or SCHG. These are essentially the same thing too. And SCHG is Schwab's large cap growth ETF, and these funds are again very highly correlated. Another one is VWO and IEMG. Both are emerging markets, different index providers. One of the most commonly used swaps at robo-advisors like Wealthfront and Betterment. Another one is VEA and IDEV, developed international markets, similar construction, different provider. The point is this: you're not changing your investment thesis, you're not timing the market, you're just holding a near identical position in a different wrapper for 31 days. Then you can swap back if you want to. Your returns look essentially the same. Your tax bill looks very different. So One thing to be aware of, some people ask about swapping VOO for IVV or SPY. Both track the S&P 500. It's the same index, different issuers. And that one is kind of gray, even for tax professionals. So, personally, I would avoid it and just use VTI instead. It's still highly correlated, but always consult with a tax advisor for your specific situation, and I am not one. So, why does this even matter? So, this is the part that no one talks about. This strategy, just like with anything else, it compounds, especially when you're young. So, when you harvest a loss today, you're not just saving money today, you're freeing up capital that gets reinvested and grows, right? So, the tax savings become part of your portfolio and time does the rest. There's also a bracket arbitrage here that works heavily in your favor when you're young. You're likely in a lower tax bracket now than you will be at 40, 45, or 50. So losses you harvest today offset income at your current rate. When your income is higher later and you eventually sell investments, you may pay a lower rate on gains than you saved at on losses. So that spread is pure financial value. So Vanguard's research quantified this. They found tax loss harvesting alpha, meaning additional after-tax return from doing this, ranges from 0.47 and 1.27% annually, depending on implementing and the investor profile. Their advisor alpha report put it even higher, up to 150 basis points or more in certain scenarios. Wealthfront publishers publishes their actual client results over the last decade. Their average client saw a harvesting yield of 3.87% annually. Even at a conservative 25% tax rate, that's nearly 1% of real after-tax benefit every year on autopilot. Those numbers don't sound huge until you actually compound them. So let's actually run some math on this. So let's say you're 23 years old with a $30,000 taxable brokerage account. The market pulls back. You're down $6,000 on one position. You harvest that $6,000 loss. You're in the 22% bracket. That's $1,320 in tax savings, and you reinvest that immediately. And 1320 compounded at 8% annually for 40 years. That single harvest is worth just under $29,000 at age 63. Now, markets they can go down, they go up, but over a 40-year investing lifetime, there will be multiple corrections, right? Multiple bear markets like we saw in 2001, 2008, 2020. There will be more. So let's say you harvest meaningful losses 5 times over your investing career. Each time you capture around 1,200 to 1,500 in tax savings, reinvested and compounded. We're talking about 100 to 150,000 additional dollars in your retirement account from zero additional risk. Zero change to your investment strategy, just being strategic about the tax timing of losses you were going to experience anyway. So, Wealthfront actually ran a simplified version of this themselves. They showed $10,000 in tax savings today, reinvested at 5% for 20 years, becomes over $26,000. Even after paying taxes on the gains from that reinvested savings, you're still up 8K. That's compounding of a deferred tax liability, and the longer the horizon, the bigger the edge you're going to have. So I want to pause on one thing people consistently miss. Even if you have zero capital gains to offset, even if you didn't sell anything else at a profit this year, you can still use up to $3,000 of harvested losses against your ordinary income, your W-2, your salary. So if you're making $60,000 a year and you're in the 22% bracket, that $3,000 deduction is worth $660 back in your pocket. Every year you have carry forward losses, that's reoccurring value. And remember, unused losses carry forward indefinitely. So a big harvest in a bad year can pay tax dividends for multiple years into the future. So this is quick but important. Tax loss harvesting only works in a taxable brokerage account. So your Roth IRA, your 401k, your HSA, those are already tax advantaged. So there's no tax event when you sell inside of them. So there's nothing to harvest. So your taxable account at Fidelity, Schwab, Robinhood, That's the playground for this strategy. And you need to pay attention to your cost basis method. So you have FIFO, which is first in, first out. It's usually the default for most brokerages, but specific share identification gives you the most control. If you bought shares at multiple price points, you want to sell the highest cost shares first to maximize the loss you can claim. Most platforms let you select this, and it usually just takes like 5 minutes to set up. Another thing I need to touch on in this video is you have two options here. You can do it yourself, monitor your taxable positions, check for losses above a threshold, say 5 or 10%, and manually execute the swap. It takes maybe an hour a few times a year during volatile markets, so it's totally doable. Or you can automate it. Wealthfront and Betterment both offer automated tax loss harvesting at no additional cost. Their software scans daily. It caught $100 million in harvestable losses in just 3 days during the market volatility in April 2025. So daily scanning is just better than human scanning. You will miss things if you're doing it manually. But I would say for most young investors under $100,000, the ETF swap approach done manually is the move. And once your situation probably gets more complicated or you're having a bigger amount, then you can always look at the automated route. Here's what's honest. So, tax loss harvesting is a deferral strategy, not permanent tax elimination. When you swap into a replacement ETF and it recovers, your cost basis is lower. So, you'll eventually owe taxes on a larger gain when you sell. The bet you're making is that the money you saved today, reinvested, and compounded for 20, 30, 40 years is worth more than the slightly higher tax bill you'll pay later. Given the time value of money for almost any young investor, that bet wins almost every time. And again, like I said, if you're not going to like sell capital gains to offset this and you're going to use it to offset your W-2 or salary income, which lowers your ordinary income, that's always taxed at a lower rate than capital gains. So that's kind of another factor in this, in my opinion, too. So there are two scenarios where you never pay it back at all. If you hold the assets until death, your heirs receive a stepped up cost basis and the gains disappear. If you donate appreciated securities to charity, that's the same result. This is why, for young people with a long horizon, tax loss harvesting can be one of the highest return, lowest risk financial decisions I think you can make. So, kind of wrap things up here. Tax loss harvesting is a selling position at a loss, swapping it into a highly correlated but not substantially identical replacement, and using that loss to reduce your tax bill today. Vanguard says the alpha from doing this runs between 47 and 127 basis points a year. Compounded over a 40-year investing career starting in your 20s, even conservative estimates put the benefit in the range of $80,000 to $150,000 in additional wealth from zero extra risk. The market going down used to feel like a problem. After today, it could be a prompt, hopefully. So the question is, can I harvest something here? If you want to help build these out, maybe actually look at the actual ETFs, the correlation coefficients, drop a comment and I'll make a follow-up video. And please like this video, comment down below. It helps the algorithm. It takes you a short amount of time, and I do plan on uploading more in the future, and I hope you enjoyed this and you found it helpful.